Welcome, everybody. This is George Veter from Veter Financial checking in with you February 22nd, giving you a little update on how we're progressing through the year. And as we just begin to wrap up, or we're on the advanced part of the first quarter, want to let you know the tone and feel of things. First of all, those of you that have been in for your reviews have seen that we've had a lot of recovery, and it's kind of been a sneak up recovery. The low for the market for most everybody and for our style of portfolio models, or most of our portfolio models, the bottom or the worst looking statements and values were in the end of September, early October. When people are coming in for their reviews, if they have like a 60-40 portfolio mix, a moderate style portfolio, which is where we attract the most type of clientele in our demographic of retirement or just pre-retirement. Those portfolio models have all had more than a 10% net recovery since October 1st. So that's pretty exciting. You can do the math on that, but just when you think it's the darkest, that's when the light happens. And the very powerful moves on the downside in a bear market are recovered much more quickly than we think we're going to be recovered on the upside. So we've had a significant recovery, but again, most people are unaware of how much better their portfolios look than they did in the fall. Also want to just address with you that there is sector rotation going on. We're a firm believer that you have to stay fully invested in multiple sectors of the economy: value and growth, small and large cap, have some foreign sleeves, and of course have a hedge with bonds. And every one of those asset classes have their good days and have their bad days, or their bad periods and good periods. Just want to report to you, last year a lot of clients would ask us, now, how come the Dow seems to be doing so much better than the NASDAQ or the S&P as an index? And that was valid. The Dow held up much better than most indexes did last year, because a lot of the consumers and investors were in large part worried about the things going on in the world. And the Dow is more representative of value type stocks and has a smaller weighting as an average towards technology or growthier style stocks. And when people get scared, they feel more comfortable buying Coca-Cola, let's say, versus Google. Now, when people start to get their air back in their sails, or the wind back in their sails, they now start kind of wanting to own Google again. And they're not as excited about Coca-Cola when they see that the economy may be getting stronger. So I'll just give you a couple of statistics that I think are interesting as of this morning. Again, February 22nd. The Dow Jones last year, in the last 12 months, the rolling 12-month period, is only down 2.79%, which is that's very defensive. That's great for what happened last year. But this year, it's negative 0.05. So it's actually lost money as an index so far this year, with a phenomenal January that we had in the general stock market, and then really solid February we've been having. Now you contrast that with the NASDAQ, which is more representative of growth, technology, and biotech. And the NASDAQ was down in the last 12 months, 15%, much bigger hit than the Dow. But so far this year, it's up just right at 10%, 9.8 as of this morning. Again, the Dow so far this year is negative, but the NASDAQ's up just under 10%. Now, the lesson we learned from that is that you can't always invest like you're picking the horse that won the last race. Whatever is hot right now, you load up on. That's like a recipe to really get hurt as an investor. In fact, a better philosophy, history tells us, is to be more contrarian, like the Warren Buffett idea of, be fearful when others are greedy and greedy when others are fearful. So, when everybody wanted the Dow style of stocks, if you loaded up on those, you're paying the price this year for lack of diversification. Also, our foreign components. When I do reviews for clients, it's interesting for them to see that the most valuable sectors represented in their portfolio are outside the United States by and large this year. Emerging markets and the EAFE index, Europe and Asia. And then also small caps, which were more volatile last year, have had really great gains. Those are carrying the biggest percentage of profits for us so far year to date. And then the large caps that everybody wanted last year, both value and to a lesser degree growth, they're trailing small caps and foreign. So again, in the words of Jack Bogle, who was the founder and former CEO of Vanguard Funds, he said, as investors, we should not be trying to find the needle in the haystack or the silver bullet. We should just own the haystack. So I want to assure you, Viter Financial clients and those of you that follow us, that we have built you haystacks. And we monitor and adjust and do little tweaks that we can to keep your money in the right position for whatever part of the cycle that we're in economically. But we're really happy with how we weathered a very difficult 2023 and how we're representing you a difficult 2022, and how we're representing you with this recovery mode that we're on in 2023. So I'm just excited for the balance of the year and look forward to communicating with you and doing your reviews and continuing to partner with you and helping you achieve your goals in the safest possible way. God bless you in this new year, and I'll look forward to our next communication.